Hello, entrepreneurs. Joe DeCharis, CPA extraordinaire, coming to you live from downtown Bethpage, Long Island, New York, for another amazing episode of How to Win at Business. And if you're watching live, give me a hashtag live. If you're watching the replay, give me a hashtag replay. If you have a question or a comment, please feel free to put it in the comment box, even if you're watching the replay, because I do get notices that somebody actually commented on this video, this training. And today, let's get right into it, because I don't want to take a lot of time. It's a complicated issue, but I'm going to break it down like I try to with everything, which is, when you file your tax return as a business, you have to have a legal structure. And I'm going to go through, there's only a couple of them, believe it or not, even though it seems overwhelmingly complicated, it's not when it comes down to it. So let's talk about the first legal structure. There's really only three when you break it down. I know it's a sixth there, and I'm going to explain uh, what I mean by there's really only three choices. But let's go into the simplest one. The IRS says it's the simplest. The SBA says it's the simplest. And it is. And it's also the most dangerous. And that's the sole proprietor. And before we get into the actual form, I'm going to go through the form and show you, what goes on it. And so what you're supposed to be giving your accountant. Not only that, when you get your return, you should be able to review this and go over it with your accountant to make sure that it's accurate and that you're on the same page. Not many of my clients through the 40 years I'm doing this have actually asked me to go through the return. I did have one client, I'll never forget him. He was OCD, and he actually wanted to go through every single document and show him where it wound up on his tax return. That was overdoing it. But I've been talking about this the last couple of days, about how important it is to prepare yourself and to educate yourself on your taxes. So the first form, whenever you go into business, knowing or not knowing, and what I mean by that is a lot of people are unknowingly going into business. Like my son-in-law, he buys and sells posters, and technically now the IRS is going to make eBay, where he does his business, make them give him a 1099, and he's in business. It's really a hobby. It's actually a hobby. He had no intention of making money. He doesn't know if he's making money or losing money. It's a hobby. He has these posters all over his house, and now by default he's a business owner, and by default he's what they call a sole proprietor. So is an Uber driver, so is a DoorDash delivery person. If you're in the gig economy, you're a sole proprietor. You're a sole proprietor by default. And what that means is you come under the jurisdiction of the IRS. You're supposed to you're required to keep books and records. And most people don't know this. Now, the tax ramifications are that you have no tax benefits as a sole proprietor. In fact, you have to, whatever your net income is, you have to pay self-employment tax, which is another word for Social Security tax. And you're going to pay about 15% in self-employment tax. So even if you're below the poverty level, if you made $20,000 net profit in your sole proprietorship, you're going to pay about $3,000 in self-employment tax. There's no way around that. You have to pay it. And now a partnership is really a sole proprietorship that has more than one owner. So a sole proprietor is just what it says, solo, and a partnership is more than one. And the tax forms are different. I'll show you the tax forms, but the taxation is actually the same. So a partnership that makes, let's say it makes $40,000, and it's split between two partners 50-50. Each of them will have to pay $3,000 in self-employment tax. And there's very few, if any, tax benefits. I mean, you could set up a pension plan, a sole proprietor can set up a pension plan, but beyond that, there's no. Oh, and also now, sole proprietors and partnerships can deduct 100% of their health insurance without itemizing their deductions. But that's a recent law change. Now, if you're limited, I'm going to jump ahead to the limited liability company and the limited liability partnership, because those became popular about 15, I'd say about 15, 20 years ago. And all that is so the IRS does not recognize an LLC or an LLP for tax purposes. What those are, it's a legal entity to protect you from lawsuits, basically. It's not going to protect you from criminal acts. But if, let's say, you have a sole proprietorship, you're an LLC, and you don't make any election, you're still taxed as a sole proprietor, but you have some limited legal liability, meaning that if there's any debt in the business and you go out of business, they can't come after you personally. Now, I'm not a lawyer, I'm a CPA, so I'm not going to give you legal advice. This is all about taxes, but the misnomer between the LLC and the LLP is that it's not covering you for tax purposes. So you're only addressing the legal purpose. So right now we have, the forms of entities. You can pick a sole proprietor or a partnership if you have more than one sole proprietor, or an LLC, which is a limited liability company, or a limited liability partnership, which is more than one member. Okay, so that's two. So there's four categories, but really only two legal structures that you can pick from. And the sole proprietor and partnership are two that you could choose to stay that way, but if you don't make a choice, you're by default a sole proprietor or a partnership. Same thing, so you can make if you're an LLC, you can make an IRS election to be taxed as a corporation, or if you're an LLP, you can also make an election to be taxed as a corporation. Now, that brings us to the corporation and the S corp. So stick with me now. There's really two legal entity types. There's the basic sole proprietor or partnership, or the limited liability company or limited liability partnership. Okay, so the last two, 5 and 6, you have to actually form at the state level. Now, corporation is the same thing. You have to form it at the state level, whatever state you're doing business in, and that is usually for a small business. It's the state that you're living in. Okay, forget about Delaware and Nevada. That's a whole nother topic for another training. Now, an S corp is another election that the IRS came up with in 1958 to help level the playing field between sole proprietors and corporations. And what an S corp is, it's still a corporation. You still get the limited legal liability, and note, you get the same protection with the corporation as you do in an LLC, which leads me to the question of, if you want the limited liability and the tax benefits, the latitude that comes with being a corporation, you don't want to be an LLC. You want to be a corporation. So now the difference between a corporation and an S corp is a corporation is taxed. If there's profits in the corporation, there's a tax. And then if the owner wants to take money out, they're taxed again, either as a salary or as a dividend. Now, if it's a salary, it's an expense of the company. So the double taxation comes in when, let's say, a corporation earns $100,000. And the owner takes a $50,000 salary. Well, the net profit of the corporation is only 50,000, and the owner, so the corporation is going to pay tax on that 50,000. The owner will pay tax on the wages that came from the corporation. Now, if the owner wants to take those profits, whatever's left after taxes, out of the corporation, they're going to take them as a dividend, and they're going to pay individual taxes again. So that's the drawback between the being a corporation or a sole proprietor. And that's where the disparity was. There was a tremendous gap between corporations and sole proprietors. Rich people own corporations. It was expensive and complicated to be a corporation. So if you were rich, you could become a corporation and become even richer because now you had more latitude. Sole proprietors stayed sole proprietors until they made a lot of money, and then you got to hire a lawyer, an accountant, and it was more complicated and expensive. So the S corp, what the S corp did was eliminate the double taxation. There is no federal level tax on an S corp. So that same scenario, the $100,000 profit, the owner takes a $50,000 salary, leaving a $50,000 profit, and there's no corporate tax. Now, as a corporation, I think that the first 50,000 is 15%. So the corporation would have paid 7,500 in tax. And then let's say there's 32.5 left over for the individual. Even if they're in the lowest tax bracket, which they wouldn't be with the $50,000 salary, that 32,000 is going to be taxed at another, let's say $6,000. So total, you're paying 13,000. So now, if it's an S corp, there's no $7,500 tax. The shareholder, the owner, will pay tax on the $50,000 salary and the $50,000 distribution at whatever their tax bracket is. Now, just to be fair, let's say it's the 15%. So that 50,000 that came from the S corp is going to cost them another 7,500. They just saved over $6,000. Now, that's a simple example, but that's how it works. Now, let me just show you some of the tax forms so that you can get familiar with them. Now, and again, this is part of my my process to get people comfortable with the tax laws, not so much with the tax laws, but what's actually involved with the tax forms. So let's see if I can do this. I believe I can. And yes, there. Okay, we will remove that one and add the Schedule C. Yes. So here is the Schedule C, basic information. Now, if you're a sole proprietor, you don't need to have a separate federal ID number. You can use your Social Security number unless you have payroll. Once you apply, once you have employees, you have to have a federal ID number. So you don't have to have employees. And another thing is you can't have yourself as an employee. I've seen a lot of people do that. It's a mistake. But this is where the numbers go after your bookkeeping and accounting is done. And it's pretty straightforward. You have your sales, your cost of sales. If you're in a resale business like retail or wholesale, you have your cost of goods sold and then your gross profit. Then you have other income that could be anything, refunds, tax refunds. It could be anything revolving around the business that doesn't have to do with your sales. And then you have your basic expenses. Now, I want you to look at this because you have advertising, car and truck expenses, commissions, depreciation, employee benefit programs, insurance, interest, Basic expenses, office. And now if there's other expenses, and there usually are, that don't fit here, you have a line 27A, which is other. And that goes on page 2. So you have a whole nother schedule. Now, if you have more categories than is here, you can always attach an additional schedule. Over here, you have some information about your auto. Here is some details about your cost of goods sold. Okay, so let me go back for a second. Uh, so that's the Schedule C. Now let's look at the partnership. Okay, so partnership is done on Form 1065. The sole proprietor is called a Schedule C on Form 1040. So this actually is part of your personal return. That's an important part, because what you're doing actually, and this is one of the drawbacks between being a sole proprietor and a separate entity, is that your business is commingled with your personal return, and that's not good. At least a partnership return separates the income and expenses from your personal return. A partnership is what they call a flow through entity, the same as an S Corp, where the profit or loss flows through to the shareholders. So you'll see, and also over here, I don't want to skip this. Up here, you gotta put your accounting method and also what kind of business it is. You want to identify what kind of business it is up in, I believe that's box B. Okay. Same thing with the partnership. In the Right under the 1065, you see that you have to look up a principal business code that's included in the instructions. You have to give them the NICS numbers and your name ID number. Now, if you're a partnership, you have to have a separate federal ID number. Same thing with a corporation and an S corp. They want to know what date the business started, total assets, where I'll show you where that, and then there's other assorted information. They want to know how many partners, uh, and then you have the same income and expenses as on a Schedule C. Every business has basically the same income and expenses. So you could, the point here is that bookkeeping is bookkeeping, accounting is accounting. When it's all said and done, you're going to have a profit and loss statement and a balance sheet. Now, on a Schedule C, there is no balance sheet. All you show is the income and expenses. Now, let me show you the rest of the form. So over here, so now it becomes a little more complicated than a Schedule C. They want to know, they have more questions. They start getting into domestic. Is it a limited partnership? Now you need an accountant. Not many people can do their own 1065 return. Tens of millions of people wind up doing their own Schedule Cs, which is a problem. And I'll tell you why. Schedule Cs are notoriously done incorrectly, and therefore they are targets for audit. Uh, so now you can see there's more questions. You actually have to designate somebody as being what they call the tax matters partner. That's the partner that's responsible, that's going to take responsibility for whatever's going on this return. In the past, people would try to play hot potato saying, I wasn't involved, I wasn't responsible. That came about 25, 30 years ago. So over here is where you get the summary of all the income and expenses. Now, they make a designation for ordinary business income and rental real estate income. And there's a good reason for that. Rental and real estate business, the rental real estate business is in a separate tax category, separate and distinct from ordinary active business entities. Why is that important? Because the net profit on rental properties are not subject to self-employment tax. So usually the strategy is to not make a rental real estate company a corporation because it actually limits you. You get all the tax benefits, you can get all the legal protection uh, through forming an LLC. So that's the for rental real estate properties, the entity of choice is to be an LLC or an LLP if you have more than one owner. Now there's other what they call flow through. So this on line one or two, that's what that's the numbers that flow through to the partners. So if this was 100,000 on line one and there's a 50-50 partnership, each partner would get a K1 for $50,000. That's what they would report on their tax return. Now, the partnership can do a lot of other things. It can have interest income. They can invest in stocks and get dividends, and so can a sole proprietor. The only difference is the sole proprietor is those income those income items are reported on their personal return. Also, they can buy and sell, a partnership can buy and sell stocks and so on. Then you have some deductions. So you see on the left-hand side, there's the income categories and there's the deduction categories. Uh, like I said, if there's a number on line one, that's going to be subject to self-employment tax, and that's on in the third category. It's going to say net earnings from self-employment income, and you're going to pick that up on your personal return and pay, 15%. Uh, and then you have some credits, and these are all, like I said, what they call flow-through items. Let's go to so now this is where you would put your balance sheet info. Schedule L is your balance sheet. And this is one of the things that sets a sole proprietor apart from the other types of legal and tax entities. You have to do an accounting. Now, this is only required if the business has over 250,000 in annual sales or net assets. So a lot of times, if it's a small business and they don't have that much going on, they don't. The entity is not required to fill this information in. They should still keep a balance sheet because even a sole proprietor should keep a balance sheet because that's just good business practices. And that's it for the partnership. Now we go to the 1120. This is a straight corporation. One distinction that an 1120 has, besides having double taxation, because you could see here on line, I'm having problems with line 30, there's taxable income, and then line 31 is total tax. So there's a tax there, but also an 1120 can have what they call a fiscal year. A partnership and an S corp are pretty much required to have a calendar year because the IRS decided that they wanted those entities to have the same year end as the individuals that own them. There are exceptions. You have to ask for the IRS's permission, but in 1120, depending on when it's begun, you can elect whatever month that you want as a year end. Now, once you have that, you can't just change it. You used to be able to do that. There wasn't that much going on with the IRS with overseeing that, but now you have to actually formally request to change the tax year. So that's important for people that have multiple entities and they want to stagger their year ends. And that's where, wealthy people have another opportunity to do some sophisticated tax planning. So I just wanted to throw that up there. But the income and expenses are basically the same. Okay. Income, expenses, again, they have, if if all your expenses don't fit on these lines, you put a schedule in there, you attach it, and you identify it as a schedule to the Form 1120. Again, you're going to don't I would not try to fill this out on your own. Again, there's questions here. Most of these questions do not apply to small businesses, but if you don't answer them correctly, it could put you in hot water. That's why it's important to have a professional. So you see, one of the questions has to do with filing a 1099, and I've been talking a lot about issuing and reporting 1099 income. That's another video that's on my YouTube channel. You can go and look at that if you're interested. And here we're back at the balance sheet. Okay, and that's four pages. No, actually, I'm sorry, 6 pages is the basic return, and then you have schedules and other information that might belong on there. So now we come to, last but not least, the 1120S form, which is the entity of choice for small businesses. Uh, Corporations have more latitude. They can be more aggressive on deductions because they're not combined with their personal tax return. They're not as under the microscope. Usually, a corporation has a professional doing their taxes, and they're less likely to get audited, which makes sense. If you're the IRS, you have limited resources, and you're going to focus on the people that make mistakes. Okay, and usually self-prepared sole proprietorships, the owners make mistakes, and that's why we started Bedrock Business Builders, to give owners of small companies, specifically sole proprietors, an affordable option to not have to do these insanely complicated tax returns on their own. So again, there's some questions here. What kind of business is it? What's the code? Date incorporated. They want to know what's your total assets, which is going to tie out to your balance sheet, income, expenses. Then you have one thing I want to show you here. I can't, but where it says sign here. So this is an important point, because anytime you sign a tax return, you, the taxpayer, the owner of the business, is attesting to the fact that under penalties of perjury, all the information on this return is accurate, not your accountant. Okay, your accountant is not responsible. Yes, your accountant has responsibilities to you, the client, ethical, moral responsibilities to do the best job that they can. You also can't be incompetent. You can get in trouble with your licensing board. I'm a CPA. I hold a license. I've never had a complaint against me. But if and I've seen and actually worked for a bunch of schlock accountants, literally criminal enterprises that I wasn't aware of when I went to work for them, but they were running tax scams. And, eventually people start complaining, and they get into trouble. Uh, Other than that, when you sign a return, you're responsible for it, which is one of the reasons why I've been trying to, not trying, but have been talking about how important it is to educate yourself on the tax return. Now, hopefully, you have a paid preparer. And one thing, if you have a preparer and they don't sign the return, that's illegal. That's a sign that they're doing something shady, and you can report them to the IRS. They call them ghost preparers because there's a reason why they're not signing those returns. They probably have already gotten into trouble, or they don't want to get into trouble because they're doing things that they shouldn't be doing. Again, page 2 is just more questions. Uh, Now, page 3 is, you saw on the partnership return, this is the same thing. These are the flow through items. Again, just like on the partnership, you have your income, your deductions, your credits, and then other items. Okay, that's where the flow through comes from. And last but not least, you have your balance sheet. So that's the story, folks. I'm sticking with it. Again, if you have any questions or comments, please post them in the chat. If you're on YouTube, you can uh, post a comment, and if it's a question, I'll answer it. If you're on YouTube, I would appreciate if you could subscribe. The subscriptions are going up. If you want to book a chat with me, I'm always willing to talk about these issues. Go to timewithjoe.com. I would love to see you visit our website. It's bedrockbusinessbuilders.com. And that's it for today. God bless. Have a great day. Have a great weekend. And I will talk to you again.